Hi guys, so I'm back again. In the previous session on ratio analysis, we discussed the definition of ratio analysis, the purpose of why we are doing the ratio analysis, and then we went on and looked at the liquidity ratios. Now, in this lesson, we will be covering the operational efficiency ratios. So pay heed to it, guys. And those of you who have still not watched the intro session, go to it and watch it first. So in the previous session, as I have repeated, I discussed for you the introduction, purpose, and liquidity ratios. Here we will discuss three operational efficiency ratios, which are very important because when you look at that firm, you get to know the working capital requirements of that firm and how efficiently the firm is conducting its operations, that is, managing its business. So without wasting any further time, let's get to it. Your first ratio is operational efficiency ratios. The first ratio in it is accounts receivable turnover. Now, of course, there is a formula for it, and we are also going to go it via the formula route. But let's try to understand, what do you mean by accounts receivable turnover? This means how many times were you able to turn over your accounts receivable during the year? Now suppose your beginning accounts receivable was 1 lakh. Your ending accounts receivable was also 1 lakh. Does this mean that you have not collected any portion of your accounts receivable? No. You made credit sales, say millions of dollars during the year. You kept on collecting cash. And ultimately, what was left, balance portion to be collected, is your closing accounts receivable. So this ratio clearly indicates that how many times during the year were you able to turn over, or in simple language, collect your accounts receivable outstanding. So the closing accounts receivable receives the portion of credit sales which is not yet collected or not yet turned over. Now, what is the formula for this? See, we are collecting accounts receivable turnover. That means how many times we collected it average during the year. The denominator will be average accounts receivable. Why average and why not closing? I'm coming into it in a fraction of a second. What is the numerator? See, accounts receivable depends on credit sales. Because if you make a sale on cash, that is cash account debit to sales, you don't have any accounts receivable. Only when you make a credit sale, you get an accounts receivable. Now, what do you mean by net credit sales? In US GAAP, they consider credit sales less all the sales returns and allowances, because for this sale there will be a lot of sales returns, perhaps some discounts that you will give for maybe early payment, cash discount, or some wholesale discount that you will give. So they take the net credit sales, that is all the credit sales you made less the sales discounts, sales allowances, and sales returns. So that is your numerator, because that is the portion you are supposed to collect. You made a credit sale of 100 rupees, out of which 30 rupees was returned to you. You are not going to collect that. So why should it be in the calculation of your accounts receivable turnover? When you make a credit sale, the journal entry is data to sales. When the goods are returned to you, you pass sales return to data. So the debtor no longer exists on your balance sheet because the goods are no longer with him. So in the numerator also, you take net credit sales. You deduct all the sales returns, sales allowances, sales discounts, because that is the portion of the accounts receivable that you are never going to collect. Because you have given them the discounts, they have returned the goods and allowances. Now, why average here? As I said, I will come to you in a second. See, net credit sales is something from income statement. So whatever comes from income statement, this happens throughout the year. It happened in January. I am looking at the gross figure, the total figure of net credit sales throughout the year. Some sales happened in January. Some sales happened in February. Some in March and so on. Now accounts receivable is a balance sheet item and balance sheet is as on date. So that is why income statement item net credit sale is for throughout the year and average AR, which is a balance sheet item. So we try to average it, taking the opening and the closing figures. This is also not the perfect representation, but it gives us a very clear picture, close to a perfect representation. Whenever you have one ratio, whenever in a ratio, you have one item belonging to income statement and one belonging to balance sheet, always average out the balance sheet, because income statement is for throughout the year and balance sheet as on date. And other examples also, logically, if you guys think, suppose I make a very big credit sale on 31st of December and I take the closing balance, it will be very high. So my ratio will not give me true figures at all, because the closing sale that I have made on 31st of December, it may be very high, perhaps more than the entire credit sale I made during the year. But will it be like outstanding forever? No, it will be collected in the normal course of cycle. So that is why we'll try to average it out so as to arrive at near to a perfect picture, even though this is not a perfect picture. So AR turnover formula is, the numerator is what the accounts receivable is dependent on, that is net credit sales. All your credit sales minus sales returns minus sales allowances and discounts. And denominator, of course, average accounts receivable. Because for accounts receivable, you have to take the average of it, right? Now this ratio denotes how many times accounts receivable was turned over during the year. That means it was collected during the year. Because your opening and credit balance, closing balance of accounts receivable, in between you have made a lot of credit sales which you have collected on due time. So this ratio simply denotes how many times you were able to turn over your entire accounts receivable during the year. Now, the formula, I've taken certain figures. So I said, let's assume for simplicity purposes, net credit sales is $100. Average AR, assume the opening AR was 40, the closing accounts receivable balance was 60. I divided it by 2, simple average. And I arrived at average accounts receivable figure. That's $50. Now, as per the formula and even going by the logic, if my net credit sales is 100 and my average accounts receivable during the entire year, because I've averaged it, now I will assume it's outstanding for the entire year, it's 50. That means my AR turnover is 2 times. I was able to collect my entire accounts receivable only 2 times during the year. Now, how do I calculate the AR in days? Simply stating, you don't even need a formula for it. You were able to collect your entire accounts receivable in 2 days. How many? 2 times during the year. How many days are there in the year? 365. Divide 365 by the AR turnover. That is the number of times you were able to collect your accounts receivable. You get the figure 182.5 days. This means on an average, your accounts receivable are outstanding for 182.5 days during the year. That shows little bit problem that perhaps you have a collection problem, or there can be certain industries where there is a long gestation period, like heavy goods, where it takes time to liquidate your inventory. So the person to whom you have also sold goods will take time to liquidate his inventory. So just by looking at this figure, you cannot directly say that they have a collection problem, because you will have to look at the industry, past patterns, historically, and what is the current market scenario to look if the company is having a collection problem. Because if indeed it is having a collection problem, that means suppose the normal credit period that the company granted to its customer was just 90 days. So that means when my average accounts receivable is outstanding for 182 days, that means some of my debts are way beyond my normal credit period. Will they pay up? Will they not pay up? I'm not sure. Perhaps every day my salesperson go to them and they say, come tomorrow. Today I have some emergency. They might not have intention to pay. So I need to make a certain provision for that, or I need to write it off accordingly as a CPA. Also, as an investor, when I look at this, I need to be very sure that the institution does not have any collection problem. Otherwise, they may have billions of dollars in their accounts receivable forever that will never be collected to cash. I may not want to invest my money in the company. And when you are as a CPA, you go to audit these companies, you want to look at these numbers very quickly. Sorry, you want to look at these numbers very closely and try to understand why is it so high. Is the industry regulate? Is the industry demands it to be so high? Is it normal for the industry, or is it normal for only this company? So this is your entire accounts receivable turnover. If I summarize it, first of all, the formula is the numerator is something which the AR is dependent on. That's net credit sales. The denominator, of course, AR turnover, that's average AR. Why average? Because credit sales is made throughout the year and accounts receivable has only as on date balance. So we take opening and closing balance and simple average it by 2. This does not also gives us an accurate or absolute accurate picture, near to accurate. And we say we will do it for simplicity purposes. What does the ratio denotes? How many times your accounts receivable was turned over during the year? How many times were you able to collect your full accounts receivable? And then the new balances start. For example, I took net credit sales 100, average AR I took opening and closing 40 plus 60 by 2, that's 50. AR turnover was 2 times. That means on an average, I was able to collect my entire accounts receivable only 2 times during the year. How do I calculate in days? 365 by 2. So 182.5 days. That is the average AR in days which is outstanding, or it takes me to collect AR. This was your first and very important operational efficiency ratio. While looking at this ratio as an auditor, you must inquire, why is the ratio so high? Why is the days so high? Ratio is so less. Is the company having a collection problem? Is the debtors refusing to pay? Or is this normal in the business? If the debtors are not paying on time and this is not a normal business practice, you may ask the company to make more provisions on this, because debtors is an asset. So your assets has to come down on the balance sheet if they are not payable. You should not misrepresent the picture. Your second operational efficiency ratio, which is primarily tested on your CPA exams, is inventory turnover. Now, same inventory turnover. So denominator is average inventory. What will be the numerator? Now, debtors was dependent on credit sales. What does inventory depend on? Cost of production. Now, that includes some ending inventory also. Cost of goods available for sale? No. From that, you have not deducted the amount sold. So the most accurate parameters as per most accountants, PhD holders who come up with this theorem was that numerator should be taken as cost of goods sold, because that only includes the inventory that was actually sold during the year. And what do I mean by inventory turnover? How many times I was able to liquidate or sell my inventory throughout the year. So when I am talking about how many times I was able to sell my entire inventory during the year, the numerator I should always take something that is relevant to sales, and here it was cost of goods sold, because only those inventory which were actually sold during the year form part of cost of goods sold. So that is why most accountants who framed this formula agreed on that the numerator should be cost of goods sold and not cost of production. Because we are talking about turnover. That means how many times inventory was liquidated during the year. Whatever, I had 100 cars. I sold 50 of them during the year. Now, if I take cost of production, I have to take it for all the 100 cars. But I am trying to find out how many times my inventory was sold during the year. So I reduce my ending inventory from it. And that gives me the cost of goods sold. And denominator will always be average inventory. Why? Same logic. When numerator, you are taking an item that belongs to income statement. Denominator, you will always include an item that is averaged, because income statement, one is balance sheet, and balance sheet items have to be averaged because they are as on date. Suppose at the last date of the year, I purchased a big amount of inventory and I take that as the denominator. My ratio will be very much less, even though I have got good efficiency in selling. So this is what we are looking at. And it's very evident. I can also show it to you. Suppose my average inventory, let's see. This denotes how many times inventory was turned over or liquidated. How many times I was able to clear out my entire inventory during the year. I have assumed a cost of goods sold of 100. I took average inventory of 15 plus 25, opening and closing. Did it simple average. I arrived at 20. So my inventory turnover was 5 times according to the formula. And in days, it means 365. If I'm able to liquidate my entire inventory 5 times during the year, that means on an average, it takes me 365 by 573 days to liquidate my entire inventory. Now, just think of it. Had I taken just the closing balance, had I taken just the closing balance, what would have happened? Cost of goods sold 100 divided by 25. It would have come to 4 times, and my inventory in days would have been more than 90. But is it correct? No, some inventory was also outstanding in the beginning, which I had also liquidated. That is what happens in these ratios. That is why we do not take the ending balance. Even this is not a very accurate presentation, but this is close to, because if I take just 25 closing balance inventory, and cost of goods sold is 100 throughout the year, it will come to 4 times. My inventory in days will be around 91. So assume I as a CPA, when I'm looking at these figures, I will feel, oh, the company takes 91 days to liquidate its inventory. It may have a selling problem. Why is it taking so long? Is it industry standards? But no, the ratio you have taken is not correct, because you're taking an ending inventory. Perhaps company's average inventory was only 15. On the last day of the year, they went ahead and purchased 10 more cars. That added to the ending inventory. So you have to average it out, because once the numerator or denominator, if it is from income statement, that is for throughout the year, something in January, something in Feb, something in March. But if you take a single balance sheet date, the results may be skewed, because on one date anything can happen. That is why we try to average it. Opening, closing, simple average divided by 2. Now with this, I move on to your third ratio, that is accounts payable turnover. Now with this, with the already 2 ratios that I have taught you, this should be like little bit easy, but still accounts payable turnover. So the denominator will be average at payables. And where does the payables create? When you make a credit purchase. For cash purchases, you don't have a payable. For cash purchase, the journal entry is purchase to cash. Only when you purchase something on credit, you have a journal entry purchase to creditors. So numerator will be credit purchase, but again net credit purchase. Why? Because perhaps you found some goods defective and you returned them. Perhaps you got some discounts. Those you are not going to pay. So why should they be in your payables? That is why we'll take net credit purchase divided by average payables. And what does this denotes? How many times accounts payable was turned over. That means how many times accounts payable was fully paid during the year. Now I find net credit purchase. I have again assumed a figure, simple figure of 100. Average payables, I again took opening and closing, very simple, 30 plus 50. And I did a simple average divide by 2, that is 40. Now AP turnover is 100 by 40, that is 2.5 times. That means on an average, I paid or I fully cleared my accounts payable 2.5 times during the year. When I take into account AP in days, it's 365 by 2.5. Forgive me for the typing error, it's written inventory days, usually AP in days, accounts payable. I find 146 days. Now, suddenly, when I go back to my ratio of accounts receivable, just give me a moment. So when I go to this ratio of accounts receivable, I see they were able to collect sales only 2 times during the year. And I was wondering if I have any collection problem because my days were coming very high, 182.50 days. So I was wondering if I have any collection problem or something. Immediately when I went to the accounts payable turnover, I saw no, I am paying my average accounts payable also in 146 days. So my creditors are also perhaps granting me that much credit. So perhaps this industry has a long gestation period where your creditors also expect you to manufacture and sell it in a period of time. And this is my inventory turnover during the time when I was able to liquidate my inventory. Now, I did describe to you these 3 ratios. But what is the effect, ultimate effect? Inventory turnover, yeah. Cost of goods sold by average inventory. And then in days, to just divide it by 365 or 360, whatever. AR turnover, net credit sales by average AR. Then the results to again divide by 365 to arrive at the days. Same with accounts payable, net credit purchase by average accounts payable. What is the effect of all this ratio? This one, guys. Remember, I taught you working capital and I told you this remains the fundamental of all the ratios. So suppose, as I told you, your introduction session, working capital is current assets minus current liabilities. Today, I will teach you a new term, working capital cycle. What is working capital cycle? If the definition, and I quote, working capital cycle is the time it takes to convert net current assets and current liabilities into cash, quote ends. What does generally it means? Generally, guys, it means is that how much time it takes from when you purchased your inventory. So how much days it takes to liquidate your inventory plus how much times it takes, how much days it takes to collect your receivables, and then you deduct when you have to pay your payables. In my example, it took me 73 days to liquidate my inventory in full, inventory in days. It took me further 182.5 days to collect my accounts receivable in full. And my creditors were supposed to be paid in 146 days. So if I look at it, from the time I purchased my inventory, it will take me 73 days plus 182 days till the time I get cash from debtors. That's around 255 days, 55.50. But I have to pay my accounts payable in 146 days. So this difference which I get is the working capital cycle. We also call it working capital gap. That means because I have to pay my accounts payable in 146 days, but I will receive payment from the inventory I sold. First of all, I sold inventory in 73. I am going to receive payment in 182, that means 255 days. I have to pay my accounts payable in 146 days. So I need money 109 days early. This is the working capital gap because my debtors will pay me after 255 days. Time it took to liquidate my inventory plus time it took to collect my receivables. But my accounts payable won't wait till then, or else my goodwill will be lost in the market. So that is working capital gap. And for this, companies go to the bank for financing. Now, lower the days, the bank will charge you less interest. Higher the days, the bank will charge you more interest. This is generally known as working capital financing. Bank will finance you for this 109 days, which you require early payment, and they will take mortgage some of your stocks and debtors alongside. This is known as cash credit or working capital management, working capital finance. And this is the entire spectrum on why operational efficiency ratios are very important. Because when you look at it, and if you see a very high ratio, sometimes you may also wonder, is my data collection department good? Or are these, this should already be bad debt? But we are not recognizing it because it reduces our income. Is my inventory being sold on time? Is my sales staff efficient? Because if the entire ratio is very bad in days, that means the cycle is very bad. Bank will charge you very high rate of interest. And we don't want to make bank a equal partner in our business because bank gives you money and then it becomes a partner in your business because whatever profit you earn, it takes interest out of it. And shareholders receive last payment after interest and taxes. So this is why these efficiency ratios are very important, guys. And as I said, that as I said, guys, that always when you study ratio, try to analyze the ratio and what is the purpose of the ratio. What are we deriving out of it? Like in AR turnover, we can clearly define that this shows how many days it takes on an average to correct my entire accounts receivable balance. If it is very high, go analytic wise on CPA basis. Is it as per the industry standards or is my data not paying up? If not paying up or very old, you need to make very high provisions that will go to your income statement and reduce your income. Because credit sales goes to your credit, right? Data to sales. So it goes to your revenues on the income statement and it is boosting your income. And if this data is not collectible, you should make a provision and reduce your income. This is the true and fair presentation. If you see your inventory is getting liquidated very slow, you should immediately ask this question: is my sales staff efficient? Or do I need to change them? Or do I need to give them some commission to make them work more? And whatever the difference, then you deduct it from accounts payable and you find out how many days early you need the payment. And then you go to a bank because if you need the payment early, you need the payment in 146 days, as per my example. The debtors from the time you sold the inventory to the time debtors will pay is 255 days. You need to arrange 3.5 months money early. You need to borrow it. Either you borrow it from your shareholders by issuing equity, but if shareholders see that you have problem, they may not want to buy your equity, or if they may want steep discounts on your equity, or you issue debt, or if your debt holder also sees a problem, be it bonds or banks, they may want more interest because they are taking a risk. And more the risk, always remember risk and reward, risk and return go hand in hand. They are directly proportional to each other. So if there is more risk involved, they will want more return. So this ratio gives a very clear picture on how an enterprise is maintaining its operations and the efficiency. So thank you guys for this time. Till next session. Bye bye. Study well. Hope you guys do well.